Before we begin, a quick and important disclaimer. The information presented in this video regarding divorce proceedings for 401k accounts, tax implications, and asset division is strictly for educational and entertainment purposes only. I am not a financial advisor, a family law attorney, a certified public accountant, or a fiduciary. The intersection of family law and retirement planning is incredibly complex, subject to rapid legislative changes, and deeply dependent on the specific statutes of your state. Do not use this video as a substitute for professional legal or financial counsel. Any case studies or historical trends discussed do not guarantee similar outcomes for your specific situation. You must conduct your own due diligence and consult with qualified professionals before making any decisions that could impact your financial security or legal standing. Right now, across the United States, an invisible wealth transfer of unprecedented scale is quietly gutting the retirement dreams of millions of Americans. It is not happening because of market crashes, inflation, or poor investment choices. It is happening in family courts. Imagine spending 30 years meticulously funding a 401k, making the maximum contributions, sacrificing vacations, and delaying gratification, only to watch a judge legally sever that nest egg with a single signature. We are going to look closely at a phenomenon that is reshaping the economic landscape of older Americans. The historical trends show a staggering shift in demographics. The rate of gray divorce, divorces among couples aged 50 and older, has doubled since the 1990s. For those over 65, the rate has tripled. These are peak earning years and, historically, the final sprint toward retirement consolidation. Instead, they are becoming ground zero for catastrophic financial fragmentation. Consider a scenario that family law attorneys see every single day. One spouse has been the primary earner, diligently building a retirement account that now shows a 7-figure balance. The other spouse might have sacrificed their own career progression to manage the household or raise children. The assumption has always been that this account is a shared life raft. But when the marriage dissolves, the reality of how that life raft is divided is shocking to almost everyone involved. It is never as simple as cutting a check. If you attempt to simply withdraw half of a 401k to pay off a soon-to-be ex-spouse, you will trigger an avalanche of early withdrawal penalties, massive federal and state income tax liabilities, and potentially bankrupt your own future. The Internal Revenue Service does not care about your divorce decree. They care about the tax code. We are talking about potential outcomes where $1 million account is suddenly worth hundreds of thousands less, simply because the individuals involved did not understand the bureaucratic machinery of asset division. This is the open loop you need to understand. The single most dangerous financial event you can experience is not a bear market. It is an unprotected, uneducated approach to dividing qualified retirement assets during a separation. There is a specific legal instrument required to split a 401k without triggering these disastrous taxes. But the shocking truth is that even minor clerical errors in this document can leave one spouse entirely destitute, with no legal recourse to recover the funds once the divorce is finalized. The stakes could not be higher, and the margin for error is absolute zero. Today, we are going to dismantle the complex, often terrifying machinery of how 401k accounts are treated during a modern United States divorce. We are going to strip away the legal jargon and examine the cold, hard realities of the marital estate. Whether you live in a community property state like California or Texas, where the prevailing assumption is a strict 50-50 split of all assets acquired during the marriage, or an equitable distribution state like New York or Florida, where a judge decides what is fair based on a multitude of subjective factors, your location dictates your financial destiny. This deep dive provides the foundation you absolutely must possess to navigate this treacherous terrain. We will explore the anatomy of the Qualified Domestic Relations Order, the specialized legal directive that forces a plan administrator to distribute a portion of your retirement plan to an alternate payee without causing a taxable event for the account holder. We will dissect historical case studies where individuals successfully protected their premarital contributions, and contrast them with devastating examples where individuals lost their entire life savings due to poor representation and fundamental misunderstandings of federal regulations. We are looking at the modern demographic landscape, a landscape where dual-income households, complex blended families, and late-in-life separations are the norm. You will learn how the courts attempt to identify what portion of a 401k is actually considered marital property versus separate property, a calculation that involves tracing contributions back decades, factoring in market gains, interest, and even employer matching contributions. We will also address the critical, often overlooked difference between the date of separation and the date of divorce when valuing these volatile accounts in a fluctuating stock market. Let us expand further on the demographic realities driving this crisis. As the baby boomer generation navigates their retirement years, we are witnessing a complete redefinition of family structure. Modern divorces are no longer just about deciding who gets the house and custody of the children. They are fundamentally about unwinding decades of deeply entangled, heavily regulated, tax-deferred wealth. When a younger couple divorces, they have time, often decades, to recover from the financial hit. They can rebuild their savings, increase their earning potential, and rely on time in the market to heal the wounds of asset division. But in the modern demographic reality of late-stage divorce, time is the one asset neither party possesses. The 401k is often the largest single asset in the marriage, frequently eclipsing the equity in the primary residence. Yet, people routinely trade liquid retirement assets for illiquid real estate without understanding the hidden tax burdens they are inheriting. You might fight aggressively to keep the house, giving up your claim to the 401k, only to realize years later that you cannot eat the drywall to pay your property taxes, while your former spouse's retirement account continues to grow tax-free. We will break down exactly why these seemingly fair trades often lead to long-term financial instability. By the end of this comprehensive breakdown, you will have a clear, step-by-step understanding of the potential outcomes you face. You will know the underlying concepts to discuss with your attorney, the financial traps to actively avoid, and the strategic foresight required to emerge from a divorce not just emotionally intact, but economically viable. This is not about exploiting the system. It is about understanding the rigid rules of the game, so that you are not left holding an empty bag at the exact moment you were supposed to be stepping into your hard-earned retirement. We are going to look at the intersection of law, long-term investing, and compounding interest, and how to protect your future when your marital status changes. Let us immediately dive into the reality of the year 2026. The financial landscape is shifting, and to understand exactly how vulnerable your assets are, we need to examine a highly realistic case study. Imagine a scenario that is playing out in family courts from Chicago to Dallas this exact week. Meet Michael, a 48-year-old software engineer, and Jennifer, a 47-year-old marketing director. They were married in 2011. Before the marriage, Michael had already accumulated $80,000 in his employer-sponsored 401k. Over the 15 years of their marriage, through aggressive saving and employer matches, that account has ballooned to $1.2 million. Now, in 2026, they are going through a heavily contested divorce. Most people, and shockingly even some inexperienced mediators, might look at that $1.2 million, subtract the original premarital $80,000, and assume the remaining $1,120,000 is strictly marital property to be split equally. This mathematical oversimplification is exactly how generational wealth is accidentally destroyed during legal proceedings. We must look at the historical trends of compound interest to understand the flaw in this logic. The initial $80,000 Michael held in 2011 did not just sit in a cash account. It was invested in mutual funds tracking the broader market. Over 15 years, through multiple bull and bear market cycles, that specific premarital block of money compounded. The passive growth on that premarital asset is, in many jurisdictions, considered separate property that belongs entirely to Michael. If we apply historical market data, that initial $80,000 might have tripled or quadrupled independently of any new money added during the marriage. We are talking about hundreds of thousands of dollars of growth that potentially belongs solely to the original account holder, before the marital portion is even calculated. But claiming this separate property requires a complex procedure called tracing. Tracing is not something your standard divorce attorney does on a Tuesday afternoon. It requires hiring a forensic accountant, who will demand quarterly statements dating back to 2011. Plan administrators routinely purge old records, making gathering this evidence incredibly difficult. If you cannot prove the exact balance on the exact date of your wedding, the court may simply deem the entire $1.2 million as marital property, instantly wiping out years of your early career labor. Furthermore, the timeline of a modern divorce introduces a massive vulnerability, known as the valuation date trap. The legal process can drag on for 18 to 24 months. Suppose Michael and Jennifer officially separated and filed their initial paperwork in March of 2025. At that moment, the 401k was worth exactly $1 million. However, the final divorce decree is not signed until August of 2026. During those 17 months of legal wrangling, the stock market surges, and the account jumps by $200,000. The critical question becomes, who is entitled to that growth? If the state jurisdiction dictates using the date of separation for asset valuation, Jennifer's share is permanently locked to the $1 million valuation, meaning Michael keeps the entirety of the market gains that occurred during the separation. Conversely, if the state uses the date of distribution, Jennifer shares in that $200,000 uplift. This single legal nuance dictates hundreds of thousands of dollars in potential outcomes and is one of the most fiercely litigated aspects of high net worth divorces. Once the court finally determines exactly how much of the account belongs to each party, you face the bureaucratic nightmare of actual distribution. You cannot simply write a settlement agreement stating your ex-spouse receives $500,000 and expect the plan administrator to cut a check. Financial institutions managing 401k plans are governed by strict federal laws under the Employee Retirement Income Security Act. They will reject any standard court order. They require a highly specific, separate legal document called a Qualified Domestic Relations Order, or QDRO. The QDRO is the only instrument that forces a plan administrator to carve out a portion of your retirement plan for an alternate payee without triggering massive, immediate tax penalties for the account holder. But drafting a QDRO is essentially writing specialized legal code, and minor clerical errors lead to catastrophic financial outcomes. The precise wording of the QDRO determines who bears the risk of market volatility between the day the divorce is finalized and the day the funds are actually moved, a process that can take up to 6 months. Consider the catastrophic difference between drafting a QDRO using a flat dollar amount versus a percentage. Imagine the QDRO explicitly states Jennifer is to receive a flat $500,000 from the account. The day before the plan administrator processes the transfer, a global economic event causes the market to crash by 20%. The total account value plummets. Because the QDRO demanded a flat $500,000, that exact amount is transferred to Jennifer. Michael's remaining share absorbs 100% of the market loss, effectively devastating his remaining retirement balance. Had the QDRO been drafted to award Jennifer a specific percentage of the account, both parties would have shared the market loss equally until the precise moment the funds were segregated. Even when a QDRO is executed flawlessly, the alternate payee faces a dangerous intersection of family law and tax code. The funds transferred via QDRO are pre-tax dollars. If Jennifer rolls her awarded share directly into her own individual retirement account, she successfully defers the taxes, preserving the capital for her own retirement. However, in the chaotic aftermath of a divorce, many individuals desperately need liquidity to purchase a new home or pay off legal debts. If an individual takes a cash distribution directly from the QDRO transfer, they trigger a massive taxable event. The distribution is added to their gross income for the year, potentially pushing them into a much higher tax bracket, resulting in a staggering tax bill come April. There are obscure, one-time IRS exceptions built into the QDRO process that can sometimes waive the 10% early withdrawal penalty for those under age 59 and a half, but these require exact execution and professional tax planning to utilize correctly. The mechanics of splitting a standard, fully funded account are complex enough, but the modern reality is that most 401k accounts are not simple buckets of cash. What happens when the retirement account includes unvested company stock options that technically hold zero value today, but could be worth millions in 5 years? Or far more commonly, what happens when there is an active loan against the 401k that was taken out to remodel the marital home or pay for a child's college education? How do family courts divide a heavily regulated asset that technically carries a legally binding debt? And perhaps most terrifyingly, what legal mechanisms exist to prevent a vindictive soon-to-be ex-spouse from liquidating the entire account, taking the tax penalty, and hiding the cash before the ink is even dry on the initial divorce filings? To answer that terrifying question, we must look at the immediate legal mechanisms triggered the exact second a divorce petition is filed and served. In many jurisdictions across the United States, filing for divorce automatically activates what is known as an automatic temporary restraining order, or a standing financial injunction. This is a legally binding freeze on all marital assets, strictly prohibiting either spouse from transferring, liquidating, hiding, or borrowing against any property, especially qualified retirement accounts like a 401k. If an individual attempts to drain their 401k after this order is in place, they are not just making a poor financial choice, they are in direct contempt of court. A judge can and routinely will sanction the offending spouse, potentially awarding the entirety of the remaining balance, plus attorney's fees, to the victimized spouse. But here is the critical vulnerability in the year 2026. The financial freeze only begins upon the official filing and service of the legal paperwork. There is a deeply dangerous gray zone in the weeks or months leading up to the divorce where one spouse might be quietly preparing to exit the marriage. Imagine if a spouse, anticipating a divorce, requests a massive hardship withdrawal or takes out the maximum allowable 401k loan, funneling that cash into an undisclosed cryptocurrency wallet or a shadow bank account before the divorce petition is ever stamped by a clerk. While forensic accountants can track the origin of the withdrawal, recovering liquid cash that has been intentionally hidden is a grueling, expensive, and sometimes impossible battle. The paper trail exists, but the physical capital might be gone, leaving the court to attempt to make the victimized spouse whole by awarding them a larger share of the remaining, less liquid assets like the physical house. This brings us directly to one of the most complex and frequently mismanaged aspects of the modern marital estate: the active 401k loan. The current economic environment has driven thousands of Americans to tap into their retirement savings early to cover rising living costs, fund home renovations, or consolidate high-interest debt. Let us look at a highly realistic case study. Consider Robert and Emily, a couple living in Ohio. 3 years ago, they took a $50,000 loan from Robert's 401k to build a large addition onto their primary residence. Now, in 2026, they are divorcing. The house, which increased in value due to the renovation, is being sold to split the equity. But Robert's 401k still has an outstanding loan balance of $35,000. How do family courts divide an asset that essentially owes money to itself? You must understand that a 401k loan is not a traditional debt like a mortgage or a credit card. It is a loan where Robert borrowed his own retirement funds, and his current biweekly paycheck is being automatically garnished to repay the principal plus interest back into his own account. When the marital estate is divided, that $35,000 outstanding balance is effectively a phantom asset. If the court simply looks at the current statement balance, they are missing the fact that the account is artificially deflated by the active loan. In an equitable distribution scenario, the legal strategy often involves adding the outstanding loan balance back into the total value of the 401k to determine its true marital worth. If Robert keeps his 401k, he also assumes the full burden of the repayment. Therefore, Emily might receive a larger portion of the home sale proceeds to offset the fact that Robert is keeping the vehicle that holds the debt. But the true danger lies in the potential outcomes if Robert loses his job or simply decides to quit during the chaotic divorce transition. If employment is terminated, the entire outstanding balance of a 401k loan typically becomes due immediately. If Robert cannot repay that $35,000 within the tight window dictated by the IRS, the loan defaults. It is then treated as a deemed distribution. Suddenly, Robert is hit with a massive income tax bill on the $35,000, plus a 10% early withdrawal penalty if he is under the age of 59 and a half. This unexpected tax bomb can completely derail a meticulously negotiated settlement agreement, throwing both parties back into litigation to argue over who is responsible for the newly generated tax liability. Moving beyond active loans, we must examine the intricate web of modern corporate compensation. Standard mutual fund investments are relatively straightforward to value, but the modern 401k often includes complex, unvested assets. In 2026, it is incredibly common for employers to offer lucrative matching contributions or company stock options that vest over a 3 to 5 year period. This creates a fascinating and highly contentious legal battleground. Imagine if you have been working for a rapidly growing tech firm for 2 years. Your employer has matched 50% of your 401k contributions, but those matching funds do not legally belong to you, meaning they do not vest until you hit your 4-year work anniversary. You are now going through a divorce. Your spouse's legal team argues that those unvested funds, which currently show on your monthly statement as a significant dollar amount, are marital property subject to division. Your attorney will counter that those funds hold a present value of zero because if you were fired tomorrow, that money would vanish. How do courts resolve this contradiction? They rely on historical trends and established legal formulas, often referred to as the time rule or a coverture fraction. The court attempts to calculate what percentage of the vesting period occurred during the marriage versus after the date of separation. The judge may issue a deferred distribution order, meaning your former spouse will not receive their share of those specific employer matches until the exact future date that they successfully vest. But this creates a dangerous, lingering financial tether between two people who desperately want to sever ties. It requires ongoing monitoring of the account for years after the final divorce decree. Furthermore, if the employee spouse voluntarily quits their job, intentionally forfeiting those unvested assets just to spite their ex-spouse, the court may intervene. If a judge determines the job loss was a deliberate attempt to destroy marital wealth, they can impute the value of those lost assets onto the offending spouse, forcing them to pay the ex-spouse out of their own pocket using separate, post-marital income. You are beginning to see that dividing a 401k is fundamentally different from dividing a bank account. It is a living, breathing financial entity deeply entangled with federal tax codes, employer regulations, and the unpredictable variables of the stock market. We have covered the protective freeze of filing, the phantom mathematics of active loans, and the future promises of unvested employer matches. But everything we have discussed so far operates under the assumption that the funds will eventually be properly segregated and rolled over into a new retirement account to continue growing tax-deferred. What happens when the reality of modern demographics hits, and one spouse urgently needs cash today to survive the financial devastation of a sudden household separation? What if the soon-to-be ex-spouse has zero retirement savings of their own, massive credit card debt, and cannot afford to wait 20 years to access their awarded share of the 401k? There is an incredibly specific, highly misunderstood exception buried within the Internal Revenue Service Code. It is a one-time loophole that allows an alternate payee to pull cash directly out of their ex-spouse for 401k settlement without paying the devastating 10% early withdrawal penalty, regardless of their age. But executing this legal maneuver requires absolute perfection in drafting the court orders. If your attorney uses the wrong form, checks the wrong box, or routes the money through the wrong temporary account, the IRS penalty exemption evaporates instantly. The moment the cash hits your personal bank account, you could suddenly owe the federal government tens of thousands of dollars in unavoidable taxes and penalties, turning your divorce settlement into a financial catastrophe. The exact mechanics of this obscure tax loophole are completely unforgiving, and the historical case studies of those who failed to execute it correctly are chilling. Let us examine the precise anatomy of this exception, known in tax law as Internal Revenue Code Section 72T2C. Under normal circumstances, if you pull money out of a 401k before turning 59 and a half, the IRS hits you with ordinary income tax plus a brutal 10% early withdrawal penalty. But if you are the alternate payee receiving funds through a qualified domestic relations order, the federal government grants you a rare waiver. You can take a cash distribution from your ex-spouse's 401k without paying that 10% penalty. It sounds like a lifeline, especially in the turbulent economic climate of 2026, where liquid cash is king. However, you must understand a critical distinction that trips up thousands of divorcing Americans every year. Penalty-free does not mean tax-free. You still owe standard federal and state income taxes on every single dollar you withdraw. Let us look at a case study that illustrates the devastating consequences of a slight procedural misstep. Imagine a woman named Sarah, a 50-year-old teacher in Arizona going through a finalized divorce in 2026. Her settlement awards her $150,000 from her ex-husband's 401k. Sarah urgently needs $50,000 in cash to secure a down payment on a new, smaller home for her and her children. The remaining $100,000 she intends to save for retirement. She consults a standard financial advisor, who lacks specific expertise in divorce tax law. The advisor tells her to do a direct rollover of the entire $150,000 into her own personal individual retirement account, commonly known as an IRA, to keep the funds safe and tax-deferred. Sarah follows this advice. The money lands safely in her new IRA. A week later, she withdraws the $50,000 she needs for her down payment. In that single moment, Sarah has triggered a catastrophic financial penalty. Why? Because the special divorce exception that waives the 10% penalty applies exclusively to funds pulled directly from the corporate 401k via the Qualified Domestic Relations Order. The absolute second that money touches an IRA, it loses its special QDRO status and falls under standard IRA rules. By rolling the money over first and withdrawing second, Sarah just cost herself an unnecessary $5,000 penalty, on top of the standard income taxes she already owes. The correct procedural execution requires surgical precision. To utilize the exception correctly, Sarah needed to instruct the 401k plan administrator to split the QDRO distribution at the source. She needed them to send $100,000 directly to her IRA and cut a check for $50,000 directly to her personal bank account. But even when executed perfectly at the source, there is another massive financial shock waiting for the alternate payee: the mandatory federal withholding tax. The Internal Revenue Service does not trust you to remember to pay your tax bill at the end of the year. Federal law dictates that when a cash distribution is made from a 401k to an alternate payee under a QDRO, the plan administrator is legally required to automatically withhold 20% of the distribution for federal income taxes. If Sarah requests $50,000 in cash, she is not getting a check for $50,000. The administrator will withhold $10,000 and send it straight to the federal government, leaving Sarah with a check for only $40,000. If she strictly needed $50,000 to close on her house, she is suddenly $10,000 short at the closing table, potentially losing the house and forfeiting her earnest money deposit. To actually receive $50,000 in hand, her legal team would need to calculate the gross amount required to net $50,000 after the mandatory 20% withholding. This requires asking the court to allocate approximately $62,500 from the 401k specifically for the cash portion. This discrepancy in math causes endless friction in settlement negotiations, as the account holder sees their retirement balance dropping by much more than the ex-spouse is actually receiving in pocketable cash. Furthermore, this 20% is just the federal withholding. It does not account for state income taxes, which in high-tax states can consume another large percentage of the settlement, leaving the payee with a fraction of the intended liquidity. Let us expand on the realities of 2026 with an imagine-if scenario regarding debt. Imagine if the separation period before the divorce was finalized lasted 2 years. During that time, one spouse was forced to move out, sign a new lease, and furnish an apartment, accumulating $30,000 in high-interest credit card debt just to survive the transition. The interest rates on those cards are sitting at 24%. When the divorce is finally decreed, that spouse is awarded a portion of the marital 401k. They now face a grueling mathematical and psychological choice. Do they roll the QDRO funds strictly into an IRA, preserving the retirement asset for the future, but leaving themselves drowning in 24% consumer debt today? Or do they take the cash distribution via the QDRO, pay the 20% mandatory withholding, pay the state income taxes, but wipe out the high-interest debt entirely? This is not a theoretical exercise. This is the grim reality of the modern marital estate division. Historical trends show that individuals who try to carry high-interest consumer debt while simultaneously preserving tax-deferred retirement accounts often end up depleting those retirement accounts entirely a few years later anyway, just under much worse tax conditions because they are no longer covered by the QDRO exception. The strategic use of a QDRO cash distribution, while painful from an immediate tax perspective, is sometimes the mathematically superior option to stop the bleeding of compounding consumer debt. But it requires comprehensive financial modeling by a specialized professional, not just a guess based on internet advice. You must meticulously trace the premarital assets. You must correctly account for the active loans. You must draft an airtight qualified domestic relations order. You must successfully navigate the treacherous tax loopholes of IRS Code Section 72 to secure the exact liquid cash you need to start your new life. You submit the paperwork to the judge signs it, and you send it off to your ex-spouse corporate human resources department, expecting a check in a matter of weeks. You finally feel a sense of relief, but then you receive a stark, automated letter in the mail that completely paralyzes the entire process. The letter states that the QDRO has been rejected, not by the judge, but by an invisible, unaccountable third-party corporate entity. What happens when the company your ex-spouse works for suddenly undergoes a massive corporate merger, files for bankruptcy protection, or simply changes their 401k record keeper right in the middle of your divorce proceedings? You are about to discover that a judge's signature is completely powerless against the internal bureaucracy of a Fortune 500 plan administrator. Under the Employee Retirement Income Security Act, a sweeping federal law that dictates the operation of private pension and retirement plans, the ultimate gatekeeper of your financial settlement is not the family court judge sitting in your local county courthouse. The true gatekeeper is the corporate plan administrator. This administrator, often a third-party financial institution or an internal corporate committee, has a strict fiduciary duty to the retirement plan itself, not to you, and certainly not to your soon-to-be ex-spouse. Their legal mandate is to protect the plan from unauthorized distributions. Therefore, when they receive a judge-signed QDRO, they do not simply comply out of respect for the state court. They subject the document to a grueling microscopic compliance review to determine if it is officially qualified under their highly specific, proprietary corporate plan document. If your attorney drafted an order asking the plan to execute a maneuver that is not explicitly permitted by the hundreds of pages of internal corporate rules governing that specific 401k, the administrator will reject it outright, rendering your hard-fought legal settlement entirely useless. Let us look at a case study from the corporate landscape of 2026 to understand the devastating financial friction this creates. Imagine David and Linda, a couple navigating a highly contentious divorce in Seattle. David is a senior engineer at a mid-sized technology firm. The cornerstone of their marital estate is his $900,401,000. After 14 agonizing months of mediation and legal billing, they finally agree to a 50-50 split. The judge signs the final divorce decree and the accompanying QDRO. Linda's attorney mails the certified documents to David's corporate human resources department. But during those 14 months of litigation, David's mid-sized technology firm was acquired by a massive global conglomerate. As part of the merger, the new parent company dissolved the old 401k plan, transferred all the assets into a new mega plan, and changed the third-party record keeper from one major financial institution to another. Furthermore, during this transition, the plan entered a mandatory 60-day blackout period where absolutely no administrative changes, distributions, or asset realignments could take place. When Linda's QDRO arrives, it references the old company name, the old plan identification number, and the old record keeper. The new corporate administrator rejects the order immediately. It is technically directing them to divide an asset in a plan that no longer exists on paper. Linda is now trapped in a bureaucratic nightmare. Her attorney must draft a completely new QDRO, petition the family court to reopen the case strictly to have the judge sign the amended order, and resubmit it to the new corporate administrator. This delay can easily consume another 4 to 6 months. But the true catastrophe is what happens to the money during this delay. The original court order awarded Linda $450,000 based on the balance at the time of the divorce. But while she is fighting the corporate bureaucracy, the market experiences a violent correction. By the time the amended QDRO is finally approved and processed, the total account balance has plummeted to $700,000. Because the original QDRO was drafted as a flat dollar amount rather than a percentage, and because it was rejected, Linda is no longer guaranteed her original settlement. The entire mathematical foundation of their divorce has crumbled, and they are forced back to the negotiating table, spending tens of thousands of dollars in new legal fees to argue over who absorbs the market loss caused by a corporate merger neither of them controlled. To avoid this exact scenario, heavily experienced family law practitioners utilize a critical, yet frequently ignored, procedural safeguard known as pre-approval. This is a step-by-step process where the drafted QDRO is sent to the 401k plan administrator for a preliminary review long before it is ever placed in front of a judge for a signature. The administrator reviews the draft, flags any language that violates their specific plan document, and provides the necessary corrections. Only after the corporate entity gives written pre-approval is the document submitted to the court. This proactive alignment between state family law and federal corporate compliance is the single most effective way to protect your assets from administrative rejection. Yet, historical trends show that thousands of divorcing individuals, attempting to save a few $100s in legal fees, skip this pre-approval step, unknowingly walking into a financial trap that could cost them a decade of retirement savings. This brings us to one of the most dangerous pitfalls in the entire divorce process: the trap of the model order. In 2026, when an employee requests information about dividing their 401k, the Corporate Human Resources Department will almost always provide a free, standardized template called a Model QDRO. To an exhausted couple bleeding money on attorney fees, this free template looks like a massive relief. They fill in the blanks, sign it, and send it to the judge. This is a catastrophic error. You must understand that the corporate attorneys who drafted that model order did not draft it to protect the employee, and they certainly did not draft it to protect the ex-spouse. They drafted it strictly to minimize administrative burden and legal liability for the corporation. Model orders almost universally default to the simplest, least nuanced methods of division. For example, a standard corporate model order will frequently ignore the concept of separate interest versus shared interest. A properly drafted separate interest QDRO severs the ex-spouse portion entirely, allowing them to manage their own investments and withdraw funds based on their own life expectancy and retirement age. A model order, however, might default to a shared interest approach, meaning the ex-spouse's payout is permanently tied to the employee. If you are the alternate payee and you use a shared interest model order, you might not be allowed to touch a single dime of your awarded settlement until your ex-spouse officially retires, even if you desperately need the funds to survive today. Furthermore, model orders frequently omit critical protective clauses regarding market fluctuations between the date of the agreement and the date of distribution, leaving the alternate payee entirely exposed to market crashes while potentially capping their participation in market gains. They often fail to address what happens to unvested employer matches, survivor benefits, or active loan balances. Relying on a corporate template to divide the largest asset in your marital estate is akin to performing your own surgery using instructions written by the hospital's risk management department. It is a fundamental abdication of your financial security. But let us imagine you navigate this flawlessly. You refuse the model order. You hire a specialized QDRO attorney. You secure corporate pre-approval. The judge signs the flawless document, and the plan administrator officially qualifies it. You breathe a sigh of relief, knowing your exact percentage is secure, and the funds will be transferred to your personal retirement account within days. But when you log into the newly created account to verify the deposit, the balance is tens of thousands of dollars lower than the court-ordered amount. You frantically call your attorney, assuming a market crash or an administrative error. But it is neither. The money is gone because while you were meticulously fighting the corporate bureaucracy at the front door, the account holder was utilizing a perfectly legal, practically invisible mechanism to quietly siphon funds out the back door, a maneuver your legal team entirely failed to anticipate or prevent. To understand this practically invisible mechanism, we must examine the dangerous chronological void, known as the administrative gap period. This is the exact window of time between the moment the family court judge signs your final divorce decree and the moment the corporate plan administrator officially processes and qualifies your qualified domestic relations order. In the year 2026, due to massive corporate consolidations and outsourced human resources departments, this gap period can easily stretch from 30 to 90 days. During this critical window, you might assume that the judge's signature acts as a magical shield over the 401k account. This is a catastrophic misconception. Under the strict federal regulations of the Employee Retirement Income Security Act, commonly known as ERISA, a state court order has absolutely no authority over a federally regulated retirement plan until the plan administrator formally accepts it. Until that specific acceptance occurs, the account holder retains full, legal, administrative control over the assets. The money is not frozen simply because you have a piece of paper signed by a local judge. Let us look at a highly realistic case study to illustrate how this gap period is actively exploited. Consider Thomas and Rachel, a couple going through a contentious divorce in Illinois. The court awards Rachel $400,000 from Thomas's primary 401k. The judge signs the final paperwork on a Tuesday. Rachel's legal team mails the QDRO to Thomas's employer on Wednesday. But Thomas, acutely aware of the administrative timeline, logs into his corporate retirement portal that exact same Wednesday evening. Because the plan administrator has not yet received and processed the QDRO, there is no official hold placed on his account. The computer system still recognizes Thomas as the sole, unrestricted owner. Thomas immediately initiates a request for the maximum allowable 401k loan of $50,000. He simultaneously files for an IRS safe harbor hardship withdrawal, claiming impending eviction due to the divorce proceedings, requesting an additional $30,000 in liquid cash. The corporate automated system, seeing no legal restrictions on the file, approves both requests within 48 hours. The plan administrator liquidates $80,000 worth of investments and wires the cash directly into a private, undisclosed bank account Thomas recently opened under a different name. 3 weeks later, when Rachel's QDRO finally reaches the correct desk at the Corporate Human Resources Department, the administrator processes the order. But when they attempt to segregate Rachel's awarded $400,000, the funds simply are not there. The account balance has been legally depleted by the account holder. The plan administrator will send Rachel a notice stating that there are insufficient funds to execute the court order. When Rachel panics and calls her attorney, she will face a brutal legal reality. Thomas did not technically steal from the 401k. He took a legally permissible loan and a federally authorized hardship withdrawal from an account he owned before the federal freeze was implemented. Rachel is now forced to initiate entirely new litigation. She must take Thomas back to family court, file motions for contempt, and attempt to force him to repay the $80,000. But if Thomas has already spent that money on his own legal fees, hidden it in decentralized cryptocurrency wallets, or funneled it to offshore accounts, Rachel has won a moral victory but suffered a devastating financial defeat. The burden of collecting the stolen settlement falls entirely on her shoulders, burning through thousands of dollars in new attorney fees just to chase the money she was already legally awarded. But outright withdrawals are not the only invisible mechanism deployed during this administrative gap. We must explore the insidious tactic of asset allocation sabotage. Suppose your finalized QDRO dictates that you receive 50% of the 401k balance calculated on the exact date the funds are physically distributed by the plan. This is a very common structure designed to ensure both parties share equally in market gains or losses during the transition. However, during the gap period, the account holder still retains the exclusive right to direct the investments within the portfolio. Imagine a vindictive spouse who is furious about losing half of their retirement. Before the QDRO is processed, they log into the portal and deliberately move the entire account balance out of highly stable, diversified index funds and plunge 100% of the capital into the most volatile, high-risk assets offered by the plan, such as aggressive emerging market funds or a failing company stock option. They are intentionally weaponizing market volatility against their former partner. If the market experiences a severe downward correction during that 90-day gap, the account could easily lose 20 to 30% of its total value. Because the QDRO stated you receive half of the value on the date of distribution, you absorb half of that intentionally engineered loss. The account holder might not care about losing their own money if it guarantees you lose yours as well. Historical trends in high-conflict divorces show this scorched-earth financial strategy is terrifyingly common. Unless your legal team proactively includes highly specific language in the initial settlement agreement, explicitly freezing the asset allocation, and stripping the account holder of their trading privileges the moment the divorce is filed, you are entirely at the mercy of their investment decisions until the moment the check is cut. Yet, there is an even darker, more devastating scenario that can occur during this fragile administrative transition. It involves the absolute worst-case intersection of modern demographics, federal law, and human mortality. The average age of individuals navigating gray divorce in 2026 is steadily rising. We are dealing with demographics in their 60s and 70s. What happens if the account holder unexpectedly passes away after the divorce is finalized by the judge, but before the QDRO is officially qualified by the corporate plan administrator? This is not a theoretical law school exercise. This is a tragic reality that completely erases millions of dollars in generational wealth every single year. Under federal ERISA law, the absolute highest governing authority regarding who inherits a 401k is the official beneficiary designation form on file with the plan administrator. State divorce decrees do not automatically update or override these corporate forms. Imagine you are awarded $1 million from your ex-spouse's retirement account. The divorce is final. You are just waiting for the QDRO to be processed. But 3 days after the court hearing, your ex-spouse suffers a fatal heart attack. The moment they die, the plan administrator looks strictly at the beneficiary form to determine where the money goes. If, during the chaotic months of separation, your ex-spouse quietly logged into their portal and changed their primary beneficiary from you to their sibling, their adult child from a previous marriage, or their new romantic partner, that new beneficiary legally inherits every single penny in the account. Your pending QDRO instantly becomes worthless paper. The federal courts have repeatedly upheld that if a QDRO is not fully qualified and accepted by the plan administrator prior to the exact minute of the account holder's death, the alternate payee's claim dies with them. The newly named beneficiary takes the money free and clear, and you are left completely destitute, with absolutely no legal recourse against the estate or the corporation. The money simply vanishes from your reality. You are now looking at a landscape filled with hidden traps. Loans, hardship withdrawals, vindictive asset reallocation, and the terrifying consequences of sudden mortality can all destroy your financial future in the blink of an eye, even after you think you have won in court. You cannot simply wait for the bureaucratic machinery to slowly process your paperwork. You must deploy a preemptive strike. There is a specific, highly specialized administrative mechanism you can trigger to legally paralyze the 401k account, freezing all loans, blocking all withdrawals, and locking the beneficiary designations long before the judge even sees your final settlement. This legal maneuver bypasses the local courthouse entirely and directly forces the Fortune 500 corporation to lock the vault. But executing this freeze requires understanding a secret trigger buried deep within the plan administrator's internal compliance manual. This trigger is formally known within the complex realm of federal employee benefits as a notice of adverse interest. In certain state jurisdictions, a similar, even more aggressive maneuver is known as a formal joinder of the plan. To understand why this is your ultimate protective weapon, you must first understand the severe disconnect between your local family court and the towering corporate entities that manage American retirement wealth. When you file a petition for divorce at your county courthouse, the judge knows, your spouse knows, and your attorneys know. But the 401k plan administrator sitting in a corporate headquarters halfway across the country has absolutely no idea that your marriage is dissolving, or that the retirement assets they manage are suddenly the subject of a bitter legal dispute. You must actively bridge this gap between state family law and federal corporate compliance, and you must do it immediately. A notice of adverse interest is a highly specific, legally drafted document sent directly to the corporate plan administrator and the legal department of your spouse's employer. This document puts the massive corporate entity on official, documented notice that the 401k account in question is now subject to a pending domestic relations proceeding, and that a qualified domestic relations order is currently being drafted by legal counsel. The moment a plan administrator receives this formal written notice, their legal reality instantly shifts. Under the strict guidelines of the Employee Retirement Income Security Act, the plan administrator holds a fiduciary duty to the plan and its rightful beneficiaries. If they are officially notified that an alternate payee, such as a divorcing spouse, is claiming a legal right to a portion of those funds, they can no longer blindly process withdrawal requests from the primary account holder. If the corporate administrator were to allow the account holder to liquidate the account after receiving a valid notice of adverse interest, the corporation itself could face catastrophic legal liability and be sued directly by the victimized spouse for breaching their fiduciary duty. Because Fortune 500 companies and third-party financial institutions despise legal liability, their internal compliance manuals dictate an immediate, automated response upon receiving this notice. They lock the vault. They place a hard administrative hold on the entire 401k account. This freeze instantly paralyzes the account holder. They cannot take out new loans. They cannot request hardship withdrawals. They cannot execute rolling transfers to outside individual retirement accounts. In many cases, they cannot even alter their beneficiary designations or change their asset allocation. Imagine if you are navigating a high net worth separation in the year 2026. Your spouse, a high-earning executive named Richard, has accrued $2.5 million in a corporate 401k. Richard is highly reactive and has a documented history of aggressive financial tactics. You do not wait for the local judge to slowly process a temporary restraining order, knowing Richard could drain the account via a smartphone app in 30 seconds. Instead, your attorney executes a synchronized strike. On the exact same morning the divorce petition is filed in court, a specialized ERISA attorney sends a notice of adverse interest via certified mail, overnight courier, and direct legal email portal to the corporate HR department and the plan's third-party record keeper. The very next morning, Richard logs into his retirement portal, intending to pull $100,000 in liquid cash to hide in an offshore account before the divorce papers are served. He clicks submit, and the screen flashes a red error code. He calls his corporate human resources department, furious, demanding his money. The representative calmly informs him that a formal administrative hold has been placed on the account due to a pending legal claim by an alternate payee, and that his access to the funds is completely suspended until the corporate legal department receives a fully qualified, judge-signed court order resolving the dispute. You have successfully neutralized his ability to drain the marital estate before he even knew he was in a fight. However, historical trends show a devastating pattern of failure when inexperienced attorneys attempt this maneuver. A notice of adverse interest is not a polite email or a generic letter asking the employer to please keep an eye on the account. To be effective, it must contain incredibly specific identifying information, explicitly cite the relevant sections of federal tax code, and formally invoke the plan's own internal hold procedures. Let us look at a case study of how this fails. Meet Emily and David in Texas. Emily's attorney sends a standard letter to David's employer simply stating that the couple is divorcing and requesting that no funds be distributed. The corporate legal department receives the letter, scans it, and determines it lacks the required statutory language to qualify as a formal notice of adverse interest under federal law. They classify it as an informational memo and file it away without placing a hold on the account. 2 weeks later, David requests a maximum loan against his 401k, and the system automatically approves it, wiring the money to his private bank account. Emily loses $50,000 of her potential settlement because her legal team did not understand the rigid, unyielding language required to trigger the corporate compliance mechanism. In states like California, family law practitioners utilize an even heavier legal hammer known as joining the plan. A joinder is a formal legal pleading that literally makes the Fortune 500 corporation a named party in your divorce lawsuit. They are served with a legal summons to appear, on paper, in your family court case. This creates an impenetrable legal barrier preventing the distribution of funds without a direct court order. But you must carefully weigh the potential outcomes. Joining a massive corporate entity means your attorney is now legally tangling with a highly funded corporate legal department. They will file standardized responses and require specific procedural steps that can drastically increase your legal billing. You must conduct a cost-benefit analysis. Is the 401k account large enough? And is the threat of the spouse liquidating the assets severe enough to justify the expense of fighting a corporate giant in state court? In complex, high-asset modern divorces, the answer is almost always yes. So, you have executed the perfect strategy. Your attorney drafted a flawless notice of adverse interest. It was served correctly. The corporate plan administrator confirmed the administrative hold in writing. The vault is locked. You finally feel a profound sense of security. You believe you can now take your time, navigate a slow 2-year mediation process, fight over the valuation of the primary residence, and carefully negotiate custody, knowing the massive 401k is perfectly secure and waiting for you whenever the divorce is finally decreed. Right? This is the single most dangerous, wealth-destroying assumption in modern divorce law. The federal government does not allow you to hold a corporate retirement account hostage indefinitely while you argue in family court. Under the strict regulations of the Employee Retirement Income Security Act, when a plan administrator places a hold on an account due to a pending QDRO or a notice of adverse interest, a strict, federally mandated, unforgiving countdown clock begins ticking. You have exactly 18 months. This 18-month period is a strict federal statutory limit, designed to resolve claims quickly and return the administrative burden of the plan back to normal. If your divorce drags on due to backlogged courts, a stubborn ex-spouse, or complex business valuations, and that 18-month federal deadline expires before you can produce a fully qualified, judge-signed QDRO, the outcome is absolute. The corporate plan administrator will legally, automatically, and permanently lift the freeze. The vault swings wide open, and the account holder regains full, unhindered control of the assets, legally free to liquidate, transfer, or hide them before you have the legal paperwork required to stop them. But what exactly triggers the start of this invisible 18-month time bomb? And how do cunning, high-priced attorneys intentionally stall divorce proceedings just long enough to let that clock quietly expire and steal back the entire retirement settlement right from under your nose? The invisible countdown clock of federal ERISA law begins ticking the exact calendar day the corporate plan administrator receives the first formal communication regarding a pending legal dispute over the retirement asset. This communication is typically the notice of adverse interest or a preliminary draft of a qualified domestic relations order. From that precise moment, the federal government mandates a strict 18-month period during which the plan administrator must freeze the disputed portion of the account and await a finalized, judge-signed, and mathematically accurate order. 18 months sounds like an eternity when you are standing at the beginning of a separation. But in the heavily backlogged family court systems of 2026, 18 months is a terrifyingly brief window. Highly compensated, aggressive legal teams understand this federal statute intimately, and they actively weaponize the local court calendar to run that clock down to zero. They do not stall by simply ignoring phone calls. They stall by burying your legal team in an avalanche of procedural bureaucracy, known as the discovery phase. Imagine a scenario unfolding right now in a Manhattan family court. Meet William, a 55-year-old financial executive, and Elizabeth, his spouse of 20 years. William holds a massive corporate 401k valued at $3.5 million. Elizabeth's highly competent attorney immediately files a notice of adverse interest on day one, successfully locking down the $3.5 million. William's legal team recognizes they cannot break the federal hold, so they initiate a strategy of extreme financial attrition. They demand 15 years of Elizabeth's personal credit card statements. They schedule depositions for crucial witnesses on dates they know opposing counsel is unavailable, forcing weeks of rescheduling. But their most devastating tactic involves disputing the valuation of completely unrelated, highly illiquid assets. Elizabeth owns a small, moderately successful interior design consultancy. William's attorneys argue that this business is a massively valuable marital asset that must be offset against his 401k. They hire 3 different forensic accountants to conduct exhaustive, conflicting valuations of Elizabeth's business. Because the business valuation is now deeply contested, the judge cannot finalize the global settlement agreement. If the settlement agreement cannot be finalized, the final QDRO cannot be drafted and signed. Month 12 passes. Month 15 passes. The court grants continuances due to scheduling conflicts with the forensic accountants. Month 17 arrives, and the divorce is still mired in endless litigation over a side business worth a fraction of the retirement account. Elizabeth is running out of money to pay her attorneys, while William is intentionally burning through his current salary to stall the proceedings. Then comes the 18th month and 1 day. Under strict federal compliance rules, the corporate plan administrator looks at the file, sees that the statutory holding period has expired without the receipt of a qualified court order, and automatically lifts the notice of adverse interest. The red flag disappears from William's internal corporate portal. That very morning, William initiates a maximum allowable withdrawal and liquidates a massive portion of the account, hiding the capital before the family court judge even realizes the federal freeze has evaporated. Elizabeth's state-level legal protections were rendered entirely useless by the unyielding machinery of federal time limits. To combat this devastating strategy, specialized family law practitioners deploy a highly complex countermaneuver known as the bifurcation of the divorce proceedings. Bifurcation is the legal process of severing the divorce into separate, distinct legal actions. Instead of waiting for a single global settlement that resolves custody, real estate, business valuations, and retirement accounts all at once, your attorney petitions the court to grant the actual legal divorce and execute the division of the 401k immediately, while deferring the arguments over the remaining assets to a later trial date. By bifurcating the status of the marriage and the retirement assets, you secure the judge's signature on the QDRO months, or even years, before the fight over the interior design business or the primary residence is resolved. You take the QDRO, submit it to the corporate plan administrator, qualify the order, and secure your funds safely in your own individual retirement account long before the 18-month federal clock ever gets close to expiring. However, achieving bifurcation in 2026 is incredibly difficult. Family court judges fundamentally despise piecemeal litigation. They want cases entirely resolved and off their dockets, not split into multiple lingering trials. To convince a judge to grant a bifurcated trial specifically for the division of a 401k, your legal team must clearly demonstrate the imminent threat of extreme financial prejudice. They must present historical trends and case studies to the judge proving that if the retirement asset is left in a state of limbo while the rest of the estate is negotiated, the alternate payee faces a catastrophic risk of total financial loss due to market volatility, the expiration of the ERISA hold, or the potential mortality of the account holder. Let us explore another imagine-if scenario that routinely traps divorcing couples. Imagine if your attorney fails to request a bifurcated order, allowing the fate of your retirement settlement to become inextricably tied to the sale of the marital home. In the fluctuating economic climate of 2026, real estate markets can stagnate instantly. You agree to a settlement where you receive a specific percentage of the 401k, but the final decree states the QDRO will not be executed until the primary residence is sold and the mortgage is satisfied. You put the house on the market, but due to shifting interest rates, it sits untouched for 10 months. Because the global settlement dictates the order of operations, your attorney cannot submit the QDRO to the corporate administrator. You are now being held hostage by a completely unpredictable real estate market, watching the calendar anxiously as the 18-month federal hold period ticks away. The longer the house sits unsold, the closer you get to losing your entire legal claim to the retirement funds. This is why intertwining the execution of a federal QDRO with the liquidation of a state-level physical asset is a recipe for absolute disaster. The execution of the retirement division must be isolated and prioritized above all other financial negotiations. But let us assume you have navigated this labyrinth perfectly. You hired the right specialists. You triggered the notice of adverse interest on day one. You successfully petitioned for a bifurcated trial. You secured the QDRO. The plan administrator qualified it, and your awarded settlement is safely deposited into your personal account. You have beaten the clock, outsmarted the opposing counsel, and successfully extracted your portion of the 401k. You breathe a massive sigh of relief, believing the financial warfare is finally over. But as you sit down to review the final disclosures, a terrifying realization washes over you. You spent 2 years, tens of thousands of dollars in legal fees, and immeasurable emotional energy hyper-focusing on the heavily regulated corporate 401k. You treated it as the ultimate prize. But you are about to discover that the 401k was nothing more than a highly visible decoy. While you were fighting over the regulated retirement funds, the opposing party was quietly moving massive amounts of generational wealth into highly obscure, completely unregulated compensation packages that entirely bypass the laws of a qualified domestic relations order. What happens to your financial security when you suddenly uncover the existence of restricted stock units, hidden executive top hat plans, and decentralized digital assets explicitly designed to vanish during a divorce? The existence of restricted stock units, hidden executive top hat plans, and decentralized digital assets explicitly designed to vanish during a divorce represents the ultimate frontier of modern financial warfare. While you and your legal team are entirely consumed by the labyrinth of federal regulations governing a standard 401k, high net worth individuals in the year 2026 are frequently holding the vast majority of their actual wealth in parallel, highly complex compensation structures that do not respond to a qualified domestic relations order. A standard QDRO is entirely useless against these assets. If your forensic accounting stops at the traditional retirement account, you are potentially leaving millions of dollars of marital wealth on the table simply because you did not know where to look or how to legally extract it. We must first dissect the incredibly lucrative, yet highly volatile world of restricted stock units, commonly referred to as RSUs. In the modern corporate landscape, especially within the technology, pharmaceutical, and financial sectors, base salaries are often secondary to equity compensation. Imagine a case study involving a couple named Michael and Sarah living in California. Michael is a senior director at a major publicly traded technology firm. His traditional 401k holds $800,000, which you successfully freeze using the tactics we previously discussed. However, Michael also receives an annual grant of 10,000 restricted stock units. These are not stock options. They are a promise from the company to deliver actual shares of stock to Michael at a future date, provided he remains employed. This future date is known as the vesting cliff. During the divorce discovery phase, Michael produces his current brokerage statement, which shows only the shares that have already vested. Those vested shares are easily identifiable, highly liquid, and easily divided as standard marital property. But what about the thousands of unvested shares currently sitting in his corporate equity portal? Michael's legal team will aggressively argue that these unvested RSUs hold a present cash value of zero. They will claim that because Michael must continue to work for the company for another 3 years to actually receive the shares, those unvested units represent future income earned entirely after the date of separation, meaning you have no legal right to them. This is a terrifyingly effective argument if your attorney does not understand the historical trends of equity division. The reality is that courts recognize RSUs are frequently granted as a reward for past performance during the marriage, as well as an incentive for future retention. To capture your rightful share of these phantom assets, your legal team must deploy a highly complex mathematical formula known as the time rule, often referred to in case law as the coverture fraction. The judge will use this formula to determine exactly what percentage of those unvested shares were earned during the marriage. The calculation is meticulous. It takes the total number of months you were married between the date the RSUs were granted and the date the shares finally vest, divided by the total number of months in the entire vesting period. If that calculation determines that 60% of the unvested RSUs are marital property, you are legally entitled to half of that 60%. But because these shares do not officially exist yet, the judge cannot simply order a corporate transfer. Instead, the court issues a constructive trust order or an if, as, and when received directive. This legally forces Michael to hold your portion of the shares in a constructive trust the exact moment they vest in the future. He must immediately liquidate your specific shares and transfer the cash to you, minus the applicable taxes. If he quits his job, gets fired, or the company goes bankrupt before the vesting date, the shares vanish and you receive nothing. You are permanently tethered to his career trajectory and the future stock price of his employer, absorbing massive amounts of risk long after the divorce is finalized. But RSUs are relatively transparent compared to the dark pools of corporate wealth known as non-qualified deferred compensation plans, often referred to as top hat plans. These plans are exclusively offered to a highly select group of management or highly compensated employees. The Internal Revenue Service places strict annual contribution limits on standard 401k accounts. To bypass these limits, massive corporations offer executives the ability to defer hundreds of thousands, or even millions, of dollars of their current salary and bonuses into a top hat plan, delaying the income taxes until they retire. Here is the most dangerous, paralyzing fact regarding top hat plans. They are completely exempt from the protective regulations of the Employee Retirement Income Security Act. They are strictly non-qualified. This means the federal laws that force a plan administrator to accept a QDRO and carve out an independent account for the ex-spouse simply do not apply. You cannot legally separate a top hat plan. Imagine if your spouse has $3 million in a traditional 401k and $5 million in a deferred compensation top hat plan. You can secure your portion of the 401k through a QDRO and move it to safety. But the $5 million in the top hat plan is legally classified as an unsecured promise by the corporation to pay the executive at a future date. The executive does not actually own the money. They are merely an unsecured creditor of their own employer. If you negotiate a settlement where you give up the physical real estate or other liquid assets in exchange for a 50% share of the future payouts from this top hat plan, you are stepping into a terrifying financial trap. If the corporation files for bankruptcy 10 years from now, the creditors will seize the assets, the deferred compensation plan will be wiped out, and your awarded settlement goes to zero. Furthermore, you have absolutely no control over when the payouts occur, the investment allocations within the shadow account, or the tax burden generated when the payouts finally begin. Dividing executive deferred compensation requires a highly specialized forensic accountant to calculate the heavily discounted present value of those future, unsecured payments, allowing you to demand a buyout using safe, tangible assets today, rather than risking your future on the solvency of your ex-spouse's employer. As we move past the corporate veil, we enter the entirely unregulated, highly combative arena of decentralized digital assets. In 2026, cryptocurrency is no longer a fringe investment. It is a primary vehicle for intentionally hiding marital wealth during a divorce. Unlike a 401k administrator or a corporate human resources department that complies with subpoenas, a decentralized blockchain has no customer service desk, no compliance officer, and no central authority to enforce a family court order. Consider a scenario where an individual slowly siphons a percentage of their direct deposit into a centralized crypto exchange over a period of 4 years. Right before filing for divorce, they purchase highly volatile digital assets and immediately transfer them off the exchange onto a physical hardware wallet, a USB-like device known as cold storage. They then place this device in a hidden floor safe or a safety deposit box opened under a relative's name. When the financial disclosures are filed with the court, the individual claims a net worth completely devoid of digital assets. If you suspect hidden cryptocurrency, standard discovery requests are useless. Your legal team must subpoena the centralized exchanges to find the initial fiat currency on-ramp. Once they identify the specific wallet addresses where the funds were sent, you must hire a specialized blockchain forensic analyst. These analysts use highly sophisticated software to trace the flow of funds across public ledgers, proving exactly how much wealth was diverted. But locating the assets on the blockchain is entirely different from physically recovering them. If the opposing spouse claims they lost the physical hardware wallet or forgot the complex seed phrase required to access the funds, the court faces a digital stalemate. A judge cannot force an individual to remember a password. However, family courts in 2026 are highly accustomed to this exact tactic. When a forensic analyst proves the assets exist and the spouse claims catastrophic memory loss, judges frequently deploy a devastating legal penalty. The judge will take the total calculated value of the hidden cryptocurrency and assign 100% of that value directly to the offending spouse's side of the marital ledger. To make the victimized spouse whole, the judge will then award them a massive disproportionate share of the visible tangible assets. The offending spouse might get to keep their hidden, inaccessible digital coins, but they will lose the entire primary residence, the entire liquid savings account, and the entirety of the traditional 401k to compensate for their financial deception. You have now mapped the visible landscape of the heavily regulated 401k. You have learned to hunt down the phantom equity of RSUs and deferred compensation, and you have peered into the decentralized shadows of digital wealth. You have built a fortress of court orders, constructive trusts, and forensic analysis. You are exhausted, but you believe you have finally secured your financial future. But there is one final catastrophic oversight that destroys thousands of perfectly negotiated divorce settlements every single year. It is an error that occurs at the very end of the process, a silent mathematical trap waiting for you at the tax preparation table that can retroactively obliterate everything you just fought to protect. This silent mathematical trap is known among forensic accountants as the after-tax illusion. It preys on a fundamental discrepancy between how a state family court values a marital asset and how the Federal Internal Revenue Service intends to tax that exact same asset in the future. Imagine a scenario unfolding in a courtroom in 2026. A couple, James and Olivia, are dividing a seemingly simple $2 million estate. The primary residence holds exactly $1 million in pure equity. James holds exactly $1 million in a traditional corporate 401k. To avoid the massive expense of drafting a qualified domestic relations order and fighting with a corporate plan administrator, they agree to a seemingly perfect, completely equitable split. Olivia keeps the house, and James keeps the 401k. They sign the paperwork, the judge finalizes the decree, and they both walk away believing they each secured exactly $1 million. This is a catastrophic financial illusion that will devastate James over the next decade. The state family court looks at the current statement balance and sees $1 million. The Internal Revenue Service looks at that exact same traditional 401k and sees a massive unfunded tax liability. Every single dollar inside James's traditional 401k is pre-tax money. He has never paid income tax on the original contributions, nor has he paid tax on the 15 years of compound growth. When James eventually retires and begins taking distributions, every single dollar that leaves that account will be taxed as ordinary income. Depending on his future tax bracket and state residency, that $1 million account might only yield $700,000 in actual, spendable purchasing power. Conversely, Olivia received the primary residence. Under current federal tax law, when she eventually sells that house, she can potentially utilize the primary residence capital gains exclusion, shielding up to $250,000 of profit from taxation entirely. Even if she owes some capital gains tax, the rate is historically much lower than the ordinary income tax rate applied to retirement withdrawals. On paper, they split the estate 50-50. In the harsh reality of after-tax economics, Olivia walked away with a massive premium, while James absorbed a deferred tax bomb that will slowly detonate throughout his retirement years. This illusion becomes even more treacherous when we look exclusively at the division of the retirement assets themselves. The modern corporate 401k is no longer a single monolithic bucket of pre-tax money. In 2026, many high-earning employees have a mix of traditional pre-tax contributions and Roth post-tax contributions housed within the exact same employer plan. Let us look at a case study involving a single $1,401,000 account. Half of the account, $500,000, was funded with traditional pre-tax dollars. The other half was funded with Roth after-tax dollars. The legal settlement simply states that the account will be divided equally, with the ex-spouse receiving $500,000. If your attorney does not explicitly specify the tax characterization of the funds being transferred in the qualified domestic relations order, the corporate plan administrator might simply distribute the $500,000 entirely from the traditional, pre-tax side of the ledger to fulfill the order. You just received $500,000 that you will eventually have to pay massive income taxes on, while your ex-spouse retains the entire $500,000 Roth balance, which will grow completely tax-free for the rest of their life and be distributed tax-free in retirement. To protect yourself from this devastating disparity, your legal team must mandate a pro rata distribution in the settlement language, forcing the plan administrator to divide both the pre-tax and the post-tax buckets equally, ensuring both parties share the exact same future tax burdens and tax advantages. But even if you secure the correct pro rata division, the final, most immediate trap snaps shut the year after your divorce is finalized, right when you hand your documents over to a tax preparation professional. Let us examine the bureaucratic nightmare of IRS Form 1099-R. Whenever a corporate plan administrator distributes funds from a 401k, they are legally required to report that movement to the Internal Revenue Service using this specific document. Historical trends show a terrifyingly high rate of administrative errors when coding these forms for divorced individuals. Suppose you are the alternate payee who successfully executed a QDRO and requested a $100,000 cash distribution to secure housing. You legally utilize the obscure tax loophole we discussed earlier to avoid the 10% early withdrawal penalty. When tax season arrives in April of 2026, you receive a Form 1099-R from your ex-spouse's former employer. If the Human Resources Department used the wrong alphanumeric code in Box 7 of that form, the Internal Revenue Service computer system will automatically classify the distribution as an illegal early withdrawal rather than a qualified divorce settlement. You will immediately receive an automated, terrifying audit notice from the federal government demanding thousands of dollars in penalties you do not actually owe. You will be forced to hire a specialized tax professional to essentially fight the IRS and force the corporate administrator to issue a corrected form, a process that can take months and cost thousands in accounting fees. Furthermore, the tax trap extends to the fundamental misunderstanding of the mandatory federal withholding. If you took that $100,000 QDRO cash distribution, the plan administrator automatically withheld 20%, sending $20,000 straight to the federal government. You receive $80,000 and assume your taxes are completely settled. This is a fatal assumption. That $100,000 gross distribution is added directly on top of your normal annual salary. If you already earn $80,000 a year at your job, the QDRO cash suddenly pushes your adjusted gross income to $180,000 for the year. This aggressive bump in income pushes you into a significantly higher marginal tax bracket. The 20% that the corporate administrator blindly withheld is nowhere near enough to cover the true tax liability generated by your newly elevated tax bracket. When you file your return, you will discover that you owe a massive shortfall, potentially accompanied by underpayment penalties for failing to submit estimated quarterly tax payments throughout the year of the divorce. Individuals routinely bankrupt themselves in the first year of their newly single lives because they spent their entire QDRO settlement without holding back additional capital to cover this hidden bracket bump. You must view your divorce not just as a legal dissolution of a marriage, but as the single largest, most heavily taxed financial transaction of your entire life. You cannot rely solely on a family law attorney to navigate this intersection of federal regulation, corporate compliance, and compounding taxation. You must build a specialized team consisting of an ERISA attorney to draft the QDRO, a forensic accountant to calculate the true after-tax present value of all assets including restricted stock units and digital ledgers, and a highly competent tax professional to project your exact liabilities before you ever sign the final settlement agreement. By understanding the historical trends, anticipating the corporate friction, and strategically mapping the tax consequences, you can successfully extract your rightful share of the marital wealth and protect your financial independence. But even after you have secured your 401k, uncovered the hidden corporate equity, and survived the IRS tax audit, there is one massive, federally guaranteed pool of wealth remaining that requires no QDRO, no negotiation, and absolutely no permission from your ex-spouse. If your marriage lasted for at least 10 consecutive years, you are legally entitled to tap directly into a hidden lifetime income stream based entirely on your former partner's earning record. The rules for unlocking this specific federal benefit are incredibly rigid, and making the wrong election at age 62 will permanently destroy your maximum payout, while potentially leaving hundreds of thousands of dollars on the table. We are going to expose the hidden mechanics, the exact filing strategies, and the potential outcomes of divorced spousal Social Security benefits in our next deep dive.